CASBO. I had to be a little bit slow saying that. It's the first time I've expressed that new title. For those of you that know Molly McGee Hewitt, she has retired, and so this is officially my first week in that role. She is still available at molly@casbo.org for the next few weeks if you would like to send her congratulations and such. So first, thank you for joining us today for another important webinar in our summer speaker series. I'm really excited today to have Dean West, Gary Stein, and Sarah, who I'll introduce more formally in a moment, talking about this really important topic. But a couple things to get us started. The session will be recorded. The PowerPoint is in the Q&A box. You can find that. And then we will have question and answer for our experts at the end of this session. And so I think I did share earlier, this is a topic I absolutely love. As a global vice president for E-Trade, we were a company that was about 230% annual compounded growth. We made 14 acquisitions in an 18-month period of time. We grew from 37 employees and I got there to 5,200 in a 3.5-year period. And it was there in that environment and those conditions that I gained my great appreciation for cash and cash management. It allowed the company to pursue its growth strategies, certainly to expand personnel and facilities. But what I found, especially through the acquisition process, was that most companies would show up with their net income, their profit loss, their growth statements. And what we really dug into was cash for a number of reasons. One, it made the acquisition and the negotiation of that much more, a much different experience. If they were cash poor, we knew how we could go in with that acquisition. And if they were cash rich, we knew that would cost us more. The second was that we had to watch our own cash. As you're making 14 acquisitions in an 18-month period of time, we had to manage our own cash very tightly so that A, we could afford those, but also not affect our credit ratings and the like as we move forward. But I think what really struck me, and what I'll encourage you to do, is to really just develop a very positive relationship with cash. Knowing our cash balances, knowing exactly where we stood at every moment, allowed us very quick decision making, great insight into not only our own business, but the businesses that we were looking at. And it was just a relationship that we learned to embrace. And so I'm glad you're all here today. I know we have a large registration for this. And so I'll encourage you to really learn from Dean West, the Associate Superintendent in Orange County Department of Education. Thank you for joining us. Gary Stein, Executive Director of Business Services for Orange County. So they're tag teaming today with bringing us their expertise. And then Sarah Bachez, who's our Chief Governmental Relations Officer at CASBO. So feel free to load up the question and answer. And we will have a poll at the end. We do believe it's such an important topic for you that we can do a workshop on this, an expanded workshop, should you so desire. So you'll see that poll at the end as well. With that, I'd like to turn it over to our panel of experts. Thank you again, Gary, Dean, and Sarah for joining us today. And we'll kick it to you.
Well, thank you. I'm going to go ahead and get started. So I was just looking at the attendees, and we've got people from every part of California. So good morning, California. The agenda for today, luckily for me, I get to take all the easy parts. I get to punt all the hard things to Dean, because Dean's got a lot of expertise in this area. And so, but I'm going to start off with the agenda. We're going to talk about the current state of K-12 education. You've heard this a lot. But we're just going to kind of reiterate some of the challenges and how it affects your cash flow, really. Then we're going to get into cash flows. We're going to talk about your cash position. We're going to talk about building projections and reconciliation. And then lastly, we're going to circle around to what do you do when you're in need of funds? What do you need? Where are you going to borrow funds from, internally, externally, that kind of thing? And wrap it up with trends. So I'm going to go ahead and go to the next slide. Okay, so we all know cash is important. We hear a lot, cash is king. We hear cash shows no mercy from some of our comrades throughout the state. I tried to come up with a get you cash slogan, but what I'll say is cash, it's how you pay your bills. I mean, it's not exciting, but that's what it is. I was going to say cash is what's for dinner, or it's a mini splendor thing, but we all have a good relationship with cash. We all love it, right? But this year is a little unique. And the reason it's a little unique is that while we've had this improvement in our economy for a number of years, this is the first year we're going to see deferrals, or could see deferrals, since the Great Recession. And the purpose of the slide, I mean, obviously we've got the 11 billion. That's a number that we've talked about a lot. But if you look on the right-hand side of this graphic, what we wanted to point out is that a considerable portion of our budget, or how the state balanced our budget, is based on deferrals. So the way that they're maintaining a balanced budget is by shifting basically our cash until the following fiscal year. So that's what makes this year unique. We're hoping that it's unique and that this doesn't become the norm, but it's good that we start planning for the future. Next slide, please. So cash management obviously is critical. And as pointed out in the slide, revenue doesn't always, it's not always received before you have to expend your money. So we're familiar with this. We have various programs where it's basically reimbursement, where you have to spend the money first to get the money back later. But our biggest expenses are people, right? Our people and our benefits, 80 to 90%. And each of our positions doesn't come with a nicely prepackaged revenue that pays for everything. So we have to make sure that we're able to pay payroll, basically. We can budget, we can on paper, as Tasha pointed out, like on paper, we can look great. We can budget, everything looks fantastic. We show we've got a balance at the end of the year. But when it comes to our month to month and what we actually have in the bank, sometimes that's a different picture. So next slide, please. So every district is unique. Every district's different, has a different cash landscape, if you will. So I found this picture. I thought, well, this looks like we're going to a basic aid district. Just kidding if you're a basic aid district. But each district looks different. The revenues coming in, how they come in, your expenditures, everything looks different, which is why it's so important that we maintain the cash flow analysis. Next slide, please. Okay. So we put this slide together just to kind of describe what we mean by every district's unique. So the revenue we get in comes in from state aid, right? So we calculate our LCFF, it tells us what our entitlement is, but that money comes to us in different chunks, right? So we have local property taxes that are distributed to us, we have state aid. So depending on where your district's at and the percentage of your district as to whether or not you're receiving a majority of that through state aid or a majority of that through property taxes will basically determine how much of an impact having a deferral on your state aid causes, right? But even if you have mostly state aid, you're still going to have a challenge with regard to the months that you're paid out your property taxes, and we'll get into that in the next slide, but not next yet. So, so I just wanted to go through real quick. So the revenues, that's how we get it in, and we'll talk about how that's broken out. Your district reserves are going to play a factor. So you could be a district that maintains low reserves or the minimum, or you could be a district that has board policies that have set that reserve level higher. Depending on where you're at, you're going to be able to absorb some of these deferrals better. But what's important for everything, the key is to have strategies for managing your cash based on what your district looks like. So on average, districts came into this recession with higher reserves than they had in the past. But what we've seen over the last number of years as a county office is districts deficit spending. So because we haven't seen a recession for a while, districts started deficit spending and they're spending down some of those reserves. So the reserves that we may have had when we came into this year, those might be already being spent. And so we want to make sure that we're watching that as well. So if you look at the graphic, so districts A through D, this just helps describe just using where we get our money from, property tax or state aid, and the reserves to kind of describe where a district's at. So on the left-hand side, you have high state aid. So maybe local property taxes aren't paying as much as the percentages, and you're maintaining a low reserve. And all the way to the right-hand side, District D, where you've got high property tax, low state aid, but you have high reserves. So depending on where you're at in what type of district, if you will, or what type of LEA, This will determine kind of how well you're going to be able to handle a deferral. And so what we're going to do is we're going to take a poll, and we're going to ask you, because we're curious who we've got on the call, ask you where you fit in. Where does your LEA fit in with these categories? So are you and you can pick on the right-hand side, are you a high state aid, low property tax, and minimum reserves? Do you have high property tax, low state aid, but you're still maintaining minimum reserves? High state aid, low property tax, high reserves, or high property tax, low state aid, high reserves? Just have, how many minutes do we have, Sarah? Looks like 5.
It's just the timing. Okay. It says 5, but we'll give it a few seconds, and then once we see people logging in and everything, then we'll close it and we'll be able to see live tabulation. So we'll give it a few seconds. Michelle, can you close it now? I think that's enough time.
Gary, maybe we could go back while we're waiting and hear some of those catchy names that you had for cash.
Well, they're pretty lame, actually. So, yeah, I'm pretty ashamed of what I said before, so I'm not going to repeat it. But cash, okay. It pays the bills. But
all right, we're going to stick with that then.
Yes, we definitely, we can look as great as we can on paper, but the reality is if there's not enough cash in the treasury, we have a problem.
When Sarah and I first heard the first announcement on the budget, we were on a call later that night. I believe it was with the governor's office. I can't recall at the time, but I was just saying, deferrals are nice, as an IOU, but you can't make payroll with an IOU.
Yep.
So that was kind of the simple version of that.
That is true. That is true. Employees can't cash that. So it looks like we've got the two highest percentages are A and C. So you either are maintaining minimum reserves or you are maintaining a higher level of reserves, but in both cases, you are a high state aid district and low property tax. Okay, so these deferrals are obviously going to have, so for those who fell into that mix, so even if you have a high reserve, unless you have your full 100% reserves, which nobody does, you're going to be hit pretty hard with state deferrals because the state aid portion is what's going to be what you're going to lose at the latter portion of this year. So it's going to be critical that you follow through with making sure that you identify those gaps, and we'll talk about that, and also to find ways to fill that, which we'll also talk about opportunities for that as well. So thank you for participating. Next slide, if you don't mind. Okay. So I like to make things simple, and obviously I'm simple because of my stupid sayings that I mentioned earlier, but cash management to me is kind of like the process of minding the gap. And what I mean by that is a gap between revenue and expenditure. We threw together this graphic just to kind of help explain how the money comes in, how your expenditures flow, and where that gap is where you're going to need to find something to fill it. So if you notice the green line, it's state aid. So state aid comes in at a fairly standard clip. It comes in at a 559 usually, unless you're a district that falls into a different category. But for the majority of us, it's the 559, which means 5% in July, 5% in August, and then 9% every month past there. I know that it's not exactly 9% or exactly 5%. It does fluctuate, but in general, that's the rule we go by. So your state aid is typically designed to be somewhat flat for most of the year. This year, we'll talk about what happens to that green line when we get into the February, March those months. So property taxes, though, you get those throughout the year, but a majority, and it's roughly about 70%, come in December or in April. So you're going to have these huge spikes, which is the purple line. And so those two spikes show you, okay, yes, I'm going to get a ton more in on those couple of months. Now, what we're doing this whole time with state aid and property taxes, and I mean, obviously you've got other sources coming in, but it's not to the greatest extent, it's going to be these two chunks of money that come in for revenues. They're filling in all of the areas where your expenditures are a little bit higher than what you've got, right? So the red line is there to just describe it, district expenditures. Those fluctuate, they do, but they're typically, the patterns are pretty similar year to year for most districts. You're going to have highs and lows. You may have some surprises, and so you have to deal with that. But for the majority, your expenditures, you know kind of where they're supposed to be. And again, we talked about 80 to 90% of our budget is staff, is our benefits and our salaries. So 80 to 90% of the budget, you know pretty well where you're going before the year starts. You know about your costs, you know about the increased rates for pensions. Well, this year is a decrease, but so that's a known factor. The money coming in for state aid now is a known factor as well, right? So we're going to have to accommodate that. But if you look at the green line, and let's pretend like that I actually put the deferral in, that line would drop down to near zero in March, April, and May, and June, right? The gap between, and I have that little arrow, so the gap between where my expenditures are and my revenues, that's where we need to make sure that we have enough revenue to cover that. So if I have a ton of reserves, you notice reserves aren't on this graphic. So if I had quite a bit of reserves in the bank, that would help me shore up what I need to do to keep my bills paid. But if we have a drop off in state aid, which we're going to see, right, pending or barring any intervention by the federal government, which we'll talk about in a little bit, we're going to need to somehow fill that gap. So mind the gap. Next slide. So we mentioned the apportionment deferrals. This is more of a breakdown of that 11 billion. So it starts in February, continues through June. What I wanted to point out is it shows you the amount every month. The June deferral is the entire apportionment that's being deferred. For the rest of the months, it's actually a portion. So you will receive some funding in those months, but it's not nearly enough, right? So if you go to the next slide, we kind of give you a visual of that. So you've seen various takes on this, what we call in our county the money bags chart, right? So we've been using this for a number of years, ever since I think we went to LCFF, or actually since we had deferrals way back when. They stayed around for quite a few years. We've been maintaining the money bags charts. This is the first time we've had to dust it off. But so what we wanted to show, and that's why we have these colored percentages in there, is that in February, 55% of that apportionment you will still receive, or about 55%. These are estimates, of course. 45% will be deferred, and then for the next 3 months, you'll get 30% of what you would normally get, 70% deferred, and then 100% in June. So money will be coming in, but it's not nearly what you would expect. So go ahead and go to the next slide.
Yeah. Do you want me to take it from here, Gary, or you have
just got a couple. Yeah, go ahead.
Take the next couple. Take the next couple.
So possible federal assistance. So we and I heard this morning on my way into work that there's been some movement on the federal side, but what was written into SB 98 was that if the federal government came through with some funding for K-12, that a portion or all of the deferrals could be removed, right? So depends on how much money the state gets. I don't recall the exact figure that they need. Dean, was it?
It's 14 billion. 14 billion. If they receive 14 billion, that does not have to be for Prop 98, but if they get 14 billion in, then the Department of Finance has the ability to, or shall, reduce proportionally those deferrals.
Right. So we're looking at, sometime in December, hopefully, to hear what finally the feds come to. But I don't know. So the negotiations are still going on. It looks like there's progress a little bit this morning, but not a ton.
And Sarah will keep you updated on this this piece.
That's what I was going to say. So that's Sarah's job, thankfully.
So, back on your money chart, and so when the Department of Finances reduces those deferrals, they'll start from that February deferral and work and remove those back. Just as they placed the deferrals on, they started with June and then took May and back, and so that process will be the same.
It'll be in reverse. Okay. So let's go next slide. Okay, so what we want to emphasize here, and we've written it kind of two different ways just to make sure that we're being clear, but we want to make sure that we're advising you to plan conservatively for these deferrals. So what we mean by that is pretty much in red. You should plan on those months where you're being deferred, not receiving any of the apportionment during those months. The reason for that is that you will absolutely be in a better cash position if you're getting the 30% or you're getting a portion of it. Now that 30% could be throttled a little bit, so you might be a little less. So you don't want to plan for 30%. You want to plan for 0 those months, and that way you're always ahead of the curve on that.
And I think that goes both ways, right? And we're talking about the revenue side. The conservative thing is thinking when will be the latest you would possibly receive those monies. And so that's the conservative approach. On expenditures, it flips the other direction. So we're talking about federal requirement to spend a lot of this federal stimulus and the CARES Act and rise relief. That one you'd want to accelerate, saying that you're going to spend that money by December. So you would be saying, well, how quickly could we spend that money? And that's more conservative. When you're talking about the main purpose of sizing a cash need and what your low point in cash could be.
Okay.
So go to the next slide.
So the hardship exemption, there is something built into Prop 98, SB 98 with regard to the ability for an LEA to be exempted from the deferral. There's $100 million available for that. It's not a lot when you look at how much is being deferred, but there's very specific hardship criteria, and it's maybe difficult for LEAs to meet that. One of the things I wanted to point out is that I believe in Mike Fine from FICMAT, when he was on this in a previous CASBO presentation, he mentioned that the exact criteria for meeting this hardship criteria is the same that would mean that you're sliding towards insolvency. So the goal is not to satisfy all this. The goal would be for you to be able to manage your cash in such a way as to not need this exemption. It's there if it's absolutely necessary, but it could highlight some red flags that we need to pay attention to as well.
And I think that's really important, Gary, in the sense that this might have been an hardship recession, a lot easier to get an exemption there, but now we have more things in place, and we'll talk about those later that maybe make this hardship exemption not as needed, maybe in some cases.
Mm-hmm. Okay, now it's all you, Dean.
Sure. Okay. Well, we're going to get in a lot into the how-to piece of it, and sometimes we're getting the framework of the legislature and the scope of the problem. That's so critical to explain, but we also wanted to get to where we gave you some practical things about the how-tos, because we know we stretch in these professional developments in a lot of categories, and we want to give a little bit of a how-to to it. So within the time permitted, we'll try to move along in that fashion pretty quickly. So it's very important to talk about that this is not what a cash flow from a financing or a audit report that may be generally known in an income where you do your income statement, balance sheet, and cash flow report and those kind of sense. When we're talking about in this government sense and the tools related to sizing a TRAN, we're really specifically talking about really form cash in our SACS software reporting tool that breaks it down a month-by-month period of transactions to show an ending month cash. And so that's the focus that we'll have in the how-to piece. And next slide. And this is kind of how it works. And the next maybe 10 to 15 slides kind of goes through this process, and we'll have a little bit of narrative, but maybe we'll camp out here just a little bit. We start with a baseline, and this baseline year, which could go back and look at 1920 now, or go back and even 1819. And I did an exercise to, I can get a little rusty sometimes with doing some cash flows, and my different responsibilities have changed over the years. So I went and grabbed our our data. We have the ability to extract a base year here in our financial software. That eliminates pretty much 90% of the work. But if you're going to have to build this from scratch, you spend a lot of time here. And the reason why you may only want one base year in that case is because you really, the next step up there on the step, you'll see the formatting, right? We're really look at it as an object code. We're getting some way to take our general ledger, consolidate it down to a usable base. There's two purposes, and one of them is to just do a snapshot cash flow. Another one is for analytical review and getting down into details. The more smaller you get to look at and detail, you aim small, miss small. So that work related to, and we'll talk a little bit about that in a later slide. So thinking about a base year, looking at what the format of that report looks like, and then taking that data and calculating it. So if you have an object code based reporting, and you're looking that out month by month, and we'll get some examples later, then you want to take that hard dollar amount you had from the prior year, and for that month of July, let's say, and divide that by the total annual spend that you had for that year. That gives you a percentage, and let's say that was 9% for that month. Now you have a perspective, historical perspective about how your spend pattern is. Government agencies, especially school districts, don't have a lot of disparity between years related to spend. Like Gary was mentioning before, a lot of it's salaries based on a 10-month, 11-month, 12-month salary. That's pretty historical. The way you pay health benefits, very historical. You're paying a monthly bill. The revenue streams are apportioned in a way to try to streamline to make sure districts have cash for that regular stream. And so this deferrals is a disruption from that normalization related to what we have. And so we'll talk a little bit about that too as well. So project your current year based on historical percentages. So you would take your current project. Right now, you've just had an adopted budget, probably doing a 45-day revise, having a new stream of what you have in your budgetary categories. Taking that dollar amount and spreading it out by that percentage spend historically by month. So if you have 9% in July and 9% in August and 9% in September, you're multiplying that new budget by that is. So that takes your historical record of percentage spend and applies that to your current budget allocation. That's going to give you your 2021 budget. And then you start to deal with the one-time changes, right? You know, in your mind, I had a textbook adoption last year. I'm not going to have that again this year. That might have disrupted, if I bought those in April of last year, that might disrupt the percentage flow of my 4,000 object codes for supplies and textbooks. And so you kind of want to look at that. If you had a major transfer in and out of a fund that's not going to recur, maybe you took money back from one fund or distributed money out to a fund at the end of the year, that's going to distort that if you don't have that same type of activity. The other things that we want to look at is obviously the cash deferrals. We did the chart about February through June being pushed out. Those are February through June 2021, and that's going to be pushed out to those July, so 21, 22. So in this case, it's best to do two-year cash flows together, and that's a requirement anyways under your financial reporting. So you're going to do a 2021 and a 21-22 cash flow, and it's just as good to do those all at the same time as you build the things. You want to do your balancing each by month. Every time you complete a historical month, you have now a closed ledger or a cash balance to balance to, and you want to reflect that with actuals, and then you have a projection and you re-look at your projection. So this is a continual analysis. And not only just for cash flow of whether you need a loan at a certain point in time, but really to monitor your budget. It's a good budget monitoring tool to see whether or not you're missing something somewhere or something like that. depending on the detail level that we put it. And then the consideration of loans. That's the last step of what we're looking at this and seeing where that low point is. And if you find that that low point is October, then you're going back and looking maybe at a detailed ledger of last year's October, November, December ledger to say what date, getting more specific. So let's move into the next slide. We camped out a little bit here. These other ones don't have as much graphics, but they say similar things. And so you can reference back to this information related to the presentation too as well. So just starting from a historical record, knowing you have a consistent pattern. Next slide. And so you may want to choose 2 or more summary levels. And when you're doing this, when I say that, for SEC's form, the form cash, you are really reporting at 4-line levels for revenues and deficit summary and detail. We're going to get into those levels. But the summary level is really for that reporting, the end product. But the detail really is for that analysis, making sure you're aim small, miss small, that you're really looking at every line related to that. We'll go through that. So, but one can just roll up into the next. It doesn't have to be like you're completing 2 different reports. One can roll into the next or use subtotals in Excel. Okay, the next slide. This is using the unaudited actuals we told you, or the final budget that you had. Unaudited actuals will tie to 100% of your spend. If you're looking at every month, July through June, realizing you have an accrual column and a cash flow report, and we'll go over that a little bit later. But that percentage is best when you're looking at historical numbers to look at that final total from those historical records. Whereas when you're projecting out, you're really looking at budget because you don't have a final number yet. You're projecting what may occur. And the only thing that you have an annual number on really is the budget. So you can go look and use the final budget and you look at prior year. If you feel that you actually have a lot of unspent funds every year, if you think your budget is more of a historical perspective based on projecting the next budget, you can use that final budget. But the revenue streams and state aid, the LCFF is funded primarily through property taxes and state aid. The state aid comes out 5/5 and then 9 September through June. So that's a systematic. And now we're having that disruption, obviously, February through June. Property taxes, you saw the purple spike in the other chart, mostly coming in December and in April. So that's why we find in October, a lot of times, October is the month where we tend to have a start of a cash shortage before that big December property taxes. When you're projecting expenditures, they have their own characters. That's why we get them down into object code level, because a 10-month teacher salary is 10%, September, October, November, all the way through June. It's pretty classic. 12-month positions have that more divided by 12 month that's spread out. And so when you get those details down into lower numbers, you can see those trends a little bit. Now, some classifications have groupings of 10 and 12 month, and the percentages are a little bit different. But you'll see some of these patterns. And if you don't see these patterns in your data when you're extracting, you're looking at it and say, well, why is that? And that's where you go back and you do a little bit of dive. So go ahead to the next area. Identify what's different. 2021, obviously the cash deferrals. We talked about those. The federal ESSER, the learning loss mitigation. Now the ESSER money we got out, the COVID-19 money was forwarded out to us. The learning mitigation funds, the learning loss mitigation funds, I think those are ones where districts are struggling with now of, okay, now we know the dollar we're going to get. How is our use of that? How much of that has already occurred? How much of that is going to be now through December? And by the time we apply for that money, report that money, and get paid on that money, it's likely that that money could be as late as January. So you may want to put that revenue in January. It's going to be a significant amount of revenue. But that will be a different number for every district. So, so that's what that is and then you'll have some your expense and your revenue. We want to pay attention to that. Again, I already mentioned the inter-year loans. If you have something or one-time grants or capital expenditures, textbooks or something like that, you want to make sure if you're using 1920 as a historical perspective, you really evaluate 2021 to what's going to happen in 2020 and take those. Okay, next slide. Keeping on pace here. Cash deferrals. Now, the 8111, since you're breaking this down in object code level, 8011 is our revenue object code. Just getting a little bit of feedback. So what really is going to happen is you can put that in a due from state and maybe even more appropriately down below, where you may not normally recognize that money until you receive it. But if you want to portion it out in the 8011, there is asset and liability counts that allow you to show that money will be received later. And so sometimes that's a better spot to calculate that. Next, we need to move a little bit quicker on this. We talked a little bit about learning loss mitigation. I think that's sufficient. We already covered this slide, so we can move to the next one. We talked about loans, about if you're doing something different, that's a one-time in nature, to eliminate that. I think that's what this slide has. We talked about the shortages in October. That's a normal for a lot of districts. We initially talked about the low reserve level likely experience for low cash. Now, this year will be a little bit different from the routinely high dependence on property taxes. Sometimes, since you're not getting those, if you have a lot of property taxes, that stretch to the December, sometimes if you don't have a high reserve level, can be a stretch. Now, that flips this year with the state aid. Although the deferrals are on the back end of the year, I don't think it will have as much problem for districts, really, because now the state, the way that it's done these deferrals, has pushed them after at least the first tax payment. And before you get heavy into the deferrals, you have the second tax payment. So I think maybe we won't have as much shock on that area, and especially if we get some good legislative, the U.S. Congress and Senate, if we get something passed up there, we can eliminate some of these deferrals, and that would be next slide. Grants and entitlements, those that are non-routine, again, you'd want to, if they disrupt your cash flow channel, you want to pay attention to those, and that's going to be in your balance. Next slide. Major purchases, we talked about that. Next slide. We had a lot more detail, but we're trying to get it into usable thing within an hour. We're shooting to try to get some Q&A time too with you as well. So this is what I was talking about when I said summary level. This is the level that you report to in the cash form. There is a little bit of breakout for the LCFF, but for the federal revenues, other state, other local, you can see that it's summarized up. And the next slide, on the next slide, Sarah, if you can look at that, this will delve down to more detail. So when you're building your projection, and this is one of our districts that submitted in, they've already done their 45D revise, they've already done a projection out. You notice that the top columns all say projected. This is 2021. They don't have any actuals yet, but you can see the object code detail on the side that you have that state aid in 8011. A lot different from those accounts from 8041 down, which are property tax accounts. So you know the flow of those property tax accounts, and we as a county, and you can go to your county for schedules, a lot of these, or go to the CD website to get a reference of like how cash flows in the revenue stream, whether it's coming from the state or it's coming from local. Next slide. This is the expenditure piece as you're looking down on your cash flow. The major object code reporting is really what we're going to be eventually getting into your cash form. And then on the next slide, we show the detail. So in benefits areas, you may get a lot more detail. STRS is broken out, stripping and classified, very uniquely different characteristics sometimes. Maybe not for STRS and PERS, but when you get down to benefits or Medicare, Social Security and stuff like that. So there is different roll up from a detailed report that you're doing and to a major report. Go to the next slide. The assets and liabilities, a key piece. You realize that the county and treasury is really what you're balancing back to. So you may have cash in bank accounts or with a fiscal agent. You're going to have a lot of accounts and activity that may, and this accounts for most of the stuff that happens in June and July. In June, as you're closing your books and you extend the June 30th closing period, it's going to have a lot more balance sheet effect to it. Also, as you look at those early months of July, August, September, in the new budget, new fiscal year you're dealing with, these assets have repayment type of stuff of assets set up, assets cleared, liabilities set up, liabilities cleared. So there is a reconciliation for all these non-cash assets and liabilities. So to reconcile back to the cash county treasury. Next slide. And so in this, when you are tying back to the cash encounter, you're going to, on the top portion of your cash flow, you're going to say whether this is an actual, have you tied this out, or is it a projection? So as you're doing an actual column and you finish July, you'll say that's actual and you'll project out and reevaluate the other columns. And then at the bottom, you can see where it's circled the ending cash balance. You'll have a calculated cash balance based on what your starting balance was, your revenues and expenditures, and then your balance sheet items, to a new ending cash balance. And then you'll go to the ledger. If you go to the next slide, you'll go to the ledger and you go ahead and tie that out. So once you complete a cash flow is complete, following the monthly activities, you want to reconcile the cash to the general ledger, update the cash flow projections with the actuals, and project the cash flows, receipts, and disbursements. One of the best defined is a soft close type of things. And that is kind of like when your month end close. So we close our ledgers usually within the first 6 to 10 days following the end of the month. And then we don't allow people to post to the ledgers from accounting office and controlling the financial system. So that's kind of like a soft close. Things aren't going to change after that point in time. Sometimes when you're looking at a ledger, maybe the only data that you get is year to date. So you really need to keep a spreadsheet that will let you take July year to date, August year to date, September year to date, and then you have to do the calculation to back out September from August to get what the change was in September. That is your September monthly cash flow. Next one, and we're going to skip through these. This is like a ledger in our ledger system. Everybody's will look a little bit different, but in this one, we just pull up a cash account 9110, general fund, pull up 731, look at the actual amount. That's the amount that I'm tying back to. So next slide. Gary, do you want to kind of take them from here? Are we about at a point? I know we're trying to wrap up and get some Q&A.
I think I have 160 more slides. So
okay, yeah. Okay.
No. So yeah, so I'll just jump in. So thanks, Dean. So now what Dean's talking about, so we got through all the cash flow. We identified maybe some months where you might need cash or you might need funding. So now we need to talk about where you're going to get money from. All right, next slide. So we have internal borrowing. So we've had a lot of conversations with districts in the last month or two about internal borrowing. So you have two methods that you can use for this. So under current Ed Code 42603, you can borrow up to 75% of a fund balance with a board action. And as long as it's repaid within the same fiscal year, or if you do it towards the end of the year, then you'll have the next fiscal year to pay it back. So I keep going to call it Prop 98. SB 98 included in there a temporary provision that's valid for the next 2 years at 42603.1, where you can borrow up to 85%. What we want to point out is that if you do this, you need to have a public hearing prior to the board taking action for this borrowing. That's the major difference between the two, other than 75 versus 85%. The 42603, it's still in operation. You can use it all you want. Under the same rules. If you already had a board resolution that passed before that gave you that authority, go with it. You're good with that. So that's if you're borrowing from inside, from yourself, basically from other funds to help the general fund. Next slide. So, so this is a great slide to actually Dean put together about which funds you're likely to borrow from, or ones that usually need a temporary loan, which that you're going to use to borrow from, and then which ones you probably won't borrow from. So again, Fund 1, Fund 13, they typically need a contribution if you're going to need it. Where you're going to borrow from, Fund 17, Fund 20, Fund 40. Probably not going to borrow from your building fund or your retiree benefit fund. Just keep that in mind. Okay, next slide. Okay, Dean, I may need your help on this one. Temporary versus permanent.
Yeah, so in this case, when you move money from one fund to another, if you're moving like from money from a checking to savings account, okay, that is financially a transaction that actually is documented as a transfer in and transfer out. And that is a permanent action that you did. So you went to your board and you said, I want to transfer money from Fund 1 to Fund 40. And then you move that money. That money stays there until the board takes another action in order to move that money back or spend it in that fund. Okay, some funds are spendable, some of them are not, if they act like a savings account or they're reserved for some specific person. So those movements and those actions by the boards are transfers in and transfers out. That is very different than what we're talking about borrowing at the 75 or 85% level, which is a temporary loan. You're just taking that money for a few months for a cash need. And that's the difference. So that's the difference between the Ed Code and how you're going to financially report that at the end of the fiscal year.
Perfect. Next slide. Okay, so when we're talking about external borrowing, there's a variety of different sources. What we would recommend that you start with is to start with your county treasury. So a lot of counties, or I'll say many, I won't say a lot. Many counties have a program to where districts can borrow money from them, and it basically borrows against the school pool at that county, and then you pay it back. We've listed some of the requirements there, meaning that the Board of Supervisors for that county has to have a resolution. You're going to have to pass a resolution, and you need to coordinate with your county superintendent because they're usually the ones who make sure the payoff happens, all that kind of good stuff. So it's typically the most affordable form of borrowing because the interest is really low, or it's a couple of basis points above. I forgot what ours is, but it's pretty low. Sorry. And you're muted.
Over 10 basis points, and so that's very efficient versus going out and borrowing as a cost.
Right. So next slide. So if your county superintendent is super cash rich, they might be willing to loan you some money. Typically, we recommend going with the county treasury because most county superintendents don't have the money to loan like this, but it is authorized under Ed Code 42621 that the county superintendent can loan money if they have a program to do so. So that would be your second stop after the county treasury. There is inter and intra-year borrowing. Just keep in mind. So the county superintendent can provide you funding for that 1 year, and then you pay it back that year, or they can extend to the following year, depending on what Ed Code they're gonna loan you money using. Next slide. But I think what most people are looking for is this section right here. So if you do not have another program available to you, then you'd be looking at probably TRANs, so tax revenue anticipation notes. And so what we're going to do is do a quick run through how you would the process for obtaining a TRAN. What I'll tell you is that the companies and the organizations that offer TRANs are very, very good at this, and they're paid to help you out through the entire process. So I'm going to walk you through this real quick. But what I'm going to recommend is that if you're looking at a TRAN, you reach out to one of those agencies, and we have a couple listed at the end that are in operation right now that they'd be more than happy to walk you through the whole process. They do a lot of this. A lot of the things I'm about to say, they'll handle it for you. So TRANs actually are short-term loans. They have various time frames, various rules associated with them. When we're talking about sizing, though, there's limits on, so you can only, principal and interest cannot exceed 85% of uncollected revenues. They're going to look at your cash flow. They want to know where your lowest point is. The cash flow becomes a very central part of what they're going to use to determine how much you can borrow and when, that kind of thing. So one thing to note on this slide is it may preclude you from being able to borrow from your county treasury. And I'll have more on that in the following slide. Next slide. Okay, So if you're going to issue a trend, you need to start with a resolution. Your board's going to pass a resolution. It's going to have a lot of background information. Again, whoever you work with for this trend is going to help you prepare all of this for your board. Now, what I want to say is that second bullet, LEAs are required to disclose any non-voter approved debt to the county superintendent and the county auditor at least 30 days prior to your board taking the issuance. So, and a trend is a non-voter approved debt. So you want to make sure you do that. County office then has 15 days to comment publicly as to whether or not the LEA can repay that obligation. So just keep that in mind as you're talking about your timeframes. Go ahead and go to the next one. So after you authorize the resolution, you're going to send it to the Board of Supervisors, copy the county superintendent, copy the county treasurer. Most county treasurers are going to want a full explanation as to why you're borrowing this money. And specifically, if your county treasury has a program where they will lend you money, they're going to want to know why you're not borrowing from them. So just keep that in mind. The note at the bottom, if you have a qualified or negative interim certification in any year, you cannot issue the non-voter approved debt without the county superintendent determining whether repayment is probable. So keep that in mind, depending on your budget status. Okay, next slide. Okay, so this goes back to, I wanted to point out that borrowing funds from the county treasury, if you already owe the treasurer money and you're going to go out for a tran, you're going to want to make sure that there's some specific language about who gets paid first, and you're going to want to pay back your treasury because you have to work with them after this is done, right? But also, I just pointed out that some MOUs that for counties that do have a loan process, they may have language that bars you from issuing a tran. So you want to make sure that if you're currently in an MOU with your county treasury, that you look for that language and make sure that if you're planning on going out for a tran, that you're not prohibited from doing so because of your MOU with your treasury. Okay, so got through that. Next slide. Okay, so some tran programs. So the good news, like I mentioned, the agencies that are providing trans are well versed in the whole process. They have the resolutions. Some of them will do your cash flows for you. They will definitely walk you through the whole process, arm in arm through the whole thing, because that's what they're paid for. So what I would encourage you to do if you're looking for a trans, to reach out to whoever you're going to borrow the money from. These are two that we have been hearing about over the last couple of weeks. So CSBA has a program, California Schools Cash Reserve Program, and the California Treasurer, they are working with California School Finance Authority, and they have a pool as well, K-14 pool, and also a charter schools pool. And from what we understand, the charter schools pool it does not require that cash flow. It's a little easier for charter schools to get funding through that program. So we'd recommend you look into those and else that's available. So that, I believe, is all we have. And so we finished with a whopping 7 minutes to answer questions. So
charter schools one is a federal backed program too, so they have a purpose. Go ahead.
So I'll begin by asking the questions that are on the queue. Going back to the cash flow regarding deferrals, so are we expected to get 30% of apportionments February through May, but we should project as if we're getting 0 just to be conservative?
Yes, because I don't think that the administration knows exactly where that will fall, but based on those apportionment schedules, and so couldn't commit to a certain number. Although that might be the number today, percentage today, it could end up being different. So
tying back to the deferral language, how can we find out more about the hardship exemption and how to apply for that waiver? And I had put in our notes that section 12 of SB 98 is where you see that language that grants the authority where you have to work with your county superintendent, provide them a notice January 5th to let them know before January 5th that you need this for the February. So it's a month ahead. The districts have to work with their county offices.
And you'd have to go through all those get no's at all those other places that we have other options into as well. Yeah. I noticed there's a question out there for the, should we use the same deferrals for 21, 22? I think I would say yes. We want to do it. I mean, the reason why, even though if the federal money comes in and gets, pushed back from this year, we still have at the state, and most likely could be in that same situation. So I think from past experience, we would probably include all deferrals until we're assured that they will not occur.
And there were a few federal fund questions. One is on spending the CARES Act funding. Is it to be spent by December 30th of this year or commit in September?
Yeah, right now the target date is December 30th. Yeah, so I would say yes. You need to get that spent. So I would try to spend it by November, right? We do know that we have some payrolls and things like that you have December service that roll over into the 10th of the next month and things like that. So we're kind of looking at those and saying, what does it do? Do you need to accrue that on December 30th? Is there some way that we can show that activity that occurred is reflected, or will there be some other changes or leniency in the laws later? So we're having those discussions, but at this point, yes, you should plan on spending that money by December 30th.
And what month should we factor in the learning loss mitigation funds under cash flow?
So, I mean, it really depends on how you close your books, right? If you close your books with 50% of it spent, then you can spread that over July through December or November. But I think if you have not closed your books, if you closed your books last year and didn't spend it March through June, then you take that whole amount there and you're going to be pushing that through November. I would say July through November. And again, with expenditures, we want to show what might be the most acceleration in expenditures and what might be our shortest cash need. So the revenue would be pushed out to January.
So the CARES Act, I just wanted to, because I have some notes from our prior meeting with CDE, but looks like they're expecting to distribute the ESSER funds mid to late September. And then there's talking about portions of the learning loss mitigation, the coronavirus relief fund, and the Prop 98 portion, which was a smaller portion. That also they're expecting to turn around mid to late September. So you get 100% of those funds because they're not subject to the cash management, but the gear funds are subject to cash management, which would mean that that's going to be a reimbursement type arrangement for the gear funds.
So you'll have to go back into the CD's allocations and schedules to particularly know what those dollars amounts are different, because those are all scheduled out and those allocations are out there. So, good. Thanks a lot, Gary. Appreciate it.
And I think that answers what's the difference between ESSER and COVID-19 funds.
Yeah, there's quite a few differences, but the ESSER funds are a lot more flexible, I'll tell you that. So the learning loss mitigation has some very specific things that you have to spend it on. The ESSER, really, you can use it to continue operations in addition to all the other things that the Title I applies to and some of the other federal funds.
And the state money that came out, the $100 million, had the COVID-19 label. So that was a smaller portion, but it was the earliest portion, which we already received in 1920.
SB 117.
Can we borrow from self-insurance funds?
When you get into some of these other funds, whether it's a bond fund, a facilities fund, a self-insurance fund, you can't borrow from some debt things or some of the other obligations where something else is obligated to money a lot of times. And so some other agreements other than just what's in Ed Code, you might get rolled over into other restrictions. So what the best thing to do is reach out to your audit firm or fiscal expert in those kind of areas to analyze what your is. Even a Fund 40 that is a facilities fund, if you put that money unrestricted in there from the general fund and you haven't placed any restrictions on it, you can take that money back pretty easily. But if you sell a property and land in Fund 40, normally you'd be restricted to maintain and spend that on capital improvements. Now, we do have some flexibility this year related to the sale of land, but you need to look at the timing and what that transaction was and that flexibility. So again, always reach out to county office, auditors, and other fiscal experts that you may have to support you in those decisions, especially when it's there. And the auditors are the ones that eventually look at that for compliance. And so they're a key, the independent auditor, very key partner.
So we have two questions. I'll try to sneak them in. I thought Fund 17 was considered an extension of Fund 1. So does borrowing from Fund 17 require board action?
Yeah, it probably would not show up on your audit report, but definitely if the CDE has allowed it to be a fund and you're actually reporting separately to your own board, then I think on code, you probably want to do that inter-fund transaction there because you're separately reporting them locally as separate funds. Now, from an audit report, they do roll up, but I think I would check again on that one where it's lack of clarity because there could be some room for flexibility. But I would generally say if you're using a Fund 17 in a separate fund on your general ledger, then you should probably do a board.
And Dean, did you say that cash flows are required for 2 years?
Yes, usually that's in the SAC software that's available out there for 2 years, and those are part of the requirement, I believe. Yes. And it makes sense because you really need an 18-month horizon to kind of be looking out and planning for anyways. And so that's the methodology. And that's the reason why.
Well, with that, we conclude all our questions.
So,
thank you all. Congratulations, Tatya.
yep, that's great.
Thank you. We appreciate all your insight. This has been such a great resource for our folks. And if you want more, I think we have a poll or a survey coming out to you. If we need to expand this into more of a workshop to really dig into these, in fact, there it is, half-day workshop, let us know. And we'll round back up these experts and more to dig into this. Thank you in advance, Dean and Gary, for for agreeing to that on the fly.
Whoa.
But, again, thanks so much. Wow, what a wonderful resource. We really appreciate your time today. Thanks for joining us.
Thank you. Have a good day.
Bye-bye.